I believe crypto is building a new economy, and every single economy in the world needs insurance because it allows kind of other people to take risks to there's risks that they can't manage, and so it allows people to take risks and actually build new stuff. If you want to launch a rocket, someone's going to have insurance. If you want to build a train line, you're going to have insurance. If you're going to build a house, you're going to have insurance. Like, it's all kind of fundamentally there. And I think in the same way, crypto needs that for more and more people to join and build new things and get adoption.
Hey guys, welcome to the CoinGecko podcast. My name is Bobby. I'm the co-founder and CEO at CoinGecko. For today's episode, we have Hugh Karp, founder of Nexus Mutual. Just want to say, if you're watching this on YouTube, we at CoinGecko really appreciate it if you hit the subscribe button below. And yeah, so Hugh is an insurance professional and actually 15 years of experience in a broad range of insurance and reinsurance roles, including the CFO of UK life operations for a global reinsurer, Munich Re. He founded Nexus Mutual back in 2019, and Nexus Mutual is currently the leader in the field of decentralized insurance with active cover amount of $500 million. Welcome to the CoinGecko podcast, Hugh.
Hey, buddy. Yeah, great to be here. Thanks for having me on.
Yeah, I guess to start things off, right? I guess for some of our listeners who may not be really familiar with Nexus Mutual, can you kindly share a little bit about what Nexus Mutual is and what you guys do?
Yeah, cool. I think the main point here of what Nexus is trying to do is basically just provide an alternative way for individuals to share risk together, which is like a very, very old thing, thousands of years old. People have been doing this forever. And they do it because they want to make the society or the community more resilient to risk. People die, they can look after their family or whatever, stuff like that. And so this is a very kind of old thing. And really what we're doing is just using new technology to make it much more efficient and much more scalable and allow anyone in the world to kind of join and to make it global. And so that's kind of like the really kind of big concept. But I guess where we've started is crypto risks, because we're crypto native. The early adopters are going to be crypto native. And so we need products that they want to buy, essentially. So we're covering things like smart contract risks, custodian risks, like with exchanges or lenders like BlockFi or Nexo or something, and so basically those very native crypto risks that it's very hard to get regular insurance products from the traditional industry right now, and so that's kind of where we started. But it's really just about a community sharing risk together.
Yeah, it's interesting. I mean, you certainly provide a service that's much needed in DeFi. I mean, everyone's kind of YOLOing into all these things, and sometimes you just want to pass the risk to someone else, but there was no way of doing it before Nexus Mutual, and I'm glad that you took the opportunity to build Nexus Mutual. But before you get into Nexus Mutual, right? I mean, let's get into your background. You were the CFO of Munich Re in the UK, so one of the largest reinsurers of the world. I mean, obviously, you got something really good going on in corporate, and why do you choose to leave and end up in crypto insurance?
Yeah, I guess I kind of just discovered Bitcoin, lots of other people, a fair while ago now, 2010, 11 or so. And I played around with it for a bit, and I guess the technology fascinated me because I just thought it was fundamentally very interesting that you could send money between people without anyone else in the middle. But I guess at that point, I didn't really know what to do with it. So I was kind of aware of the industry and stuff for a while. So I just continued working in insurance for a while. But I guess I got a little bit jaded over time. I kind of felt that I guess as a big reinsurer, you're kind of at the back end of the value chain of insurance, and all we were really doing is like big, massive transactions between different insurance companies and stuff. And if you boil it down, it was possibly basically just regulatory capital arbitrage, just making sure it's the most efficient place to hold the capital. And I kind of felt much too distant from the kind of end consumer to me. And so I guess I was kind of looking for something new-ish or to do something different. And then I kind of I heard about Ethereum again. I heard about Ethereum a bit after it launched, and I guess that was kind of the aha moment for me. But basically, if you could do, I was interested in the underlying tech, but if you could write like code, like if then statements, then you can do an insurance contract, and therefore you can rebuild like kind of mutual from the ground up. So that's kind of where I was coming from and how Nexus started.
Interesting, because when you started, I mean, DeFi definitely wasn't a thing. It wasn't even called DeFi. There was no such thing. And I mean, you had this idea. I mean, it was possible to be on a smart contract, and you kind of did this. Was it in 2017, 2018 or so, kind of in the bear market? And I've heard that you kind of almost gave up because there was kind of a lack of funding back then. I mean, there wasn't any money back in the crypto space back then, and ultimately you decided to invest your own funds and kind of continue. And I guess I wanted to find out, like, what gave you the conviction to kind of go all in? Obviously, it's a big risk, right?
Yeah. So we raised around, like we built a proof of concept late 2017. We raised a kind of seed round end of 2017, early 18. And then that was kind of at the rough peak of the last, peak of ETH price. And then like ETH just obviously kept going down. And, we probably should have sold more ETH before, but, I think a lot of treasuries were like that. And we got to early 2019 and we weren't quite launched yet, but we didn't really have any money left. And so we asked around a lot of people, and we got a few people that would commit, but we needed a bit more to get to launch. And so I decided to put my own money to get it over the line. And I don't know, what's the conviction? I'm not exactly sure. I'm probably just really stubborn. I think we got so close, and to me, in my mind, if we launched and no one used it, I'd be like, oh, okay, fine. I'd be able to move on and go and do something else. That's okay. But I think it'd just always frustrate me that we never really got to see if it would actually work. And so just wanted to really get it to launch. And I guess I was lucky enough to have bought some Ether quite a while ago and managed to use that to actually took out a loan on Maker to fund the
interesting.
yeah, so Maker version 1, single collateral DAI, and use that to kind of get us to launch. So so that was pretty cool. Takes you 20 minutes to get a loan. So yeah, that was great, even if you had to click through 13 transactions or something at the time. But yeah, so I think, a bit of stubbornness, but just really wanted to see it live and working.
The next question I have is actually about insurance, right? Why do you think the crypto space needs insurance? I know you've written extensively about this, but it would be interesting to hear from your point of view on why it's important.
Yeah, I mean, I think it's the way at a very high level, I believe crypto is building a new economy, and every single economy in the world needs insurance because it allows kind of other people to take risks to there's risks that they can't manage, and so it allows people to take risks and actually build new stuff. If you want to launch a rocket, someone's going to have insurance. If you want to build a train line, you're going to have insurance. If you want to build a house, you're going to have insurance. Like, it's all kind of fundamentally there. And I think in the same way, crypto needs that for more and more people to join and build new things and get adoption. I'd also, there's a whole bunch of early adopters, which are they're generally very, risk. They're happy to take on risk, right? And so they perhaps don't want it as much, but a whole wave of new people that are going to enter the space want that. And we've seen a lot of, especially over the past 6 months to a year, a lot of institutions are asking questions and coming to us directly because they're very interested in what's going on in DeFi, but they are a bit hesitant to deploy without the appropriate kind of compliance and insurance checkboxes ticked, and so they come and talk to us to understand what's going on and things. And they're getting close, and I believe that more and more people will come across because of insurance solutions.
So you guys have been live for the past 2-3 years and selling insurance from directly to clients on your website and indirectly via resellers and all. So I'm curious to hear, right, who are the main purchasers of insurance from the past 2-3 years of experience? And then do you think there is a gap on the demand side, or is it more on the supply side on people kind of staking to open up capacity for insurance?
Yeah. I think first point just want to make is we don't actually legally sell insurance. We sell cover. It's called discretionary cover. So the members have the final say, I guess, on what claims are valid. So just get that out there. But in terms of the customers, I think it's basically there's a wide range, obviously, but at one end we've got a whole bunch of smaller kind of more retail side of things. But I think our main traction so far has been the high end of retail into whales and into funds. So basically, if you're managing larger amounts of money, or if you're risk aware because you're managing other people's money, then you're much more likely to take out cover on Nexus, because if it was there, and if the cover was there and then you had a loss event, then you have to explain it to your investors LPs. Or your LPs, then you can potentially have a bit of a problem. So that's definitely a skew to our user base, but that's also due to the fact that our kind of UX right now is a little, I guess overall it's a little on the clunky side, because you kind of have to go to whichever site you're interacting with as the primary purchase. So like a Compound or an Aave or a Maker or a Uniswap or whatever, you go and do what you want to do there, and then you come to Nexus. So that overall user flow is a bit clunky. But when we get like kind of more distribution built out, it's going to be much more easy to add on like one-click purchases or embedded cover and that type of stuff. And so then we'll get, then we strongly believe there'll be much more take up on the kind of more retail side of things.
What do you think about the supply side? Do you think there's enough capacity from the community to kind of stake and open up capacity for the insurance, for the cover?
Yeah, so we have been, I guess, supply side capital constrained we had like ever since we launched. We launched about 2 years ago, and we spent about the first 18 months being supply side capital constrained. And now we've kind of flipped around a bit, and the main thing we're going to be focusing on is demand, because we've got enough supply side capital in the mutual. However, staking is always something that we've got enough capital, and then we also need stakers to actually actively to kind of deploy that capital, I guess, more specifically. And so more stakers is obviously always good, but we've got enough. It's okay for right now, given the demand levels, but we also need to start scaling them both up in tandem. So that's always the game. You got to match the supply and the demand.
So I'm curious, right? You said like a few months ago, you had the demand side that was constrained, but now the supply side that was constrained, but now it's a demand side. What kind of changed in the past few months? Did you see demand going down? That's why kind of, or do you see like supply growing in the past few months? That's why there's more more capacity these days.
Yeah, so we had we had about 3 to 5 million of assets of TVL up until just before DeFi summer. And then we went up to, depends on the ETH price, because a lot of our capital's ETH, but then we went up to like 500 million. So we 100x'd the TVL, like the supply side capital, in a very short space of time. And so the demand is still kind of catching up to that. So we can still write like 2 to 3 times the cover that we have at the moment without any more supply side capital.
So it's mainly driven by the increase in ETH price, because your capital is held in ETH, and then your covers kind of written denominated mostly in USD amount, I suppose, right?
I guess it's a combination of two things. One, that it is denominated in ETH, but also the fact that we attracted a lot more ETH as well. So the combination of both of those compounded to give kind of a really big increase. Yeah,
and earlier you mentioned about the UX element is kind of clunky to kind of buy cover these days. How do you see kind of the insurance space progress in the coming years? Like, what do you think needs to be done so that more retail users buy insurance covers?
Yeah, I think one of the really interesting things that crypto can do that's really hard in regular insurance world is embedded or bundled products, the composability of the blockchain, basically. And so what we can do, and we're working really hard to make this work on a technical level, is basically like a covered vault, or like a Yearn vault or an idle vault, or some other type of product like that, where retail users just want to park their ETH or stablecoins or whatever. And then the idea being that you can create a kind of covered version of that, which effectively takes some of the yield, pays for the cover, and it's automatically bundled in, and it's just an embedded product. And so the user, all they do at the front end is choose, do I want the normal vault or do I want the covered vault, for a slightly lower APY? So that's the kind of user experience we're aiming for, and it's something that to me is really exciting that we can't do in the TradFi world.
So you were thinking more partnerships with players like Aave, Compound, Yearn, where and then users get a choice of like, do you want to deposit ETH or stables into the covered or the non-covered pool, and then you kind of make a choice, or do you kind of foresee Nexus Mutual building like a Yearn front end and kind of allowing people to kind of stake and deposit the ETH and USDC and kind of invest, I guess, directly with covered insurance provided?
Yeah, I think the exact strategy on how we do the distribution is still open, but there's multiple options there. I mean, the fact of the matter is someone can build that product, and then so that's kind of step one. And then, but you can also work out, like, there are multiple ways of distributing it. So you can distribute it through like the platforms themselves, so like the Aaves and the Compounds or whatever of the world, or you can create your own portals, or you can back into existing user portals like Zappa or DBank or Zerion or other places like that. So there's a whole bunch of different options there which we're continuing to explore.
So you guys support, maybe you can correct me, like how many protocols do you guys support these days, and kind of like and how do you guys onboard a new protocol or new exchange onto Nexus Mutual?
Yeah, so we support close to 100, maybe it's just slightly less than 100, but close to 100 different risks right now. So yeah, we've got quite a lot, and the cover purchases are actually really well spread across a whole bunch of different risks. So we've got a lot of diversification, which is from an insurance conceptual point of view, diversification and sharing of risk is kind of really key to making it work. So getting that diversification is key. In terms of like how we decide to like list protocols, currently that's done by the team, just for a few reasons. We're trying to work out how to do that on a sustainable, ongoing basis, and we're working towards that one as well. But it's usually driven off people asking we want to buy some cover on this, can you list it, right? And then we kind of do but we do some basic investigations just to make sure that it's legit and there aren't any quirks or whatever, and then we list it, and from that point on people can stake, and the price is determined from there, and then if that's okay, then people can buy cover.
And this year, right, we start seeing how the crypto space kind of morph from a very ETH-centric landscape to a multi-chain blockchain world, right? So I'm curious to hear, like, how do you guys at Nexus Mutual take into account this change to a multi-chain world? Do you guys support, for example, we saw SushiSwap deploying on 7 different chains now, Polygon among Phantom, and a bunch of other. Do you guys support SushiSwap on all these different chains? Yeah.
Yeah, we do. So our new protocol cover product basically covers the risks on any chain. So basically, if you have to buy cover on Ethereum with Nexus, on the Ethereum chain with Nexus, but we cover any risks on any chain. So for example, if you buy cover on SushiSwap, you get coverage on any of the 7 or so chains that it's on. Same with Aave and any other multi-chain deployment. So we kind of already built for that. I guess there's 2 kind of angles to multi-chain from a Nexus perspective. One is, do we cover risks on other chains? And yes, we do already. The second one is, can you buy Nexus cover on other chains? So Nexus deploying on other chains. And right now we're just on Ethereum, and we're kind of looking at that from a how do we do that, or how do we because deploying, just copying, pasting Nexus and deploying it on another chain doesn't actually work, because you need supply side capital, you need liquidity, and so splitting the capital pool is quite inefficient. So looking at ways of bridging cover across via tokens and other things like that is probably the more likely solution. But right now, we're focusing on a few other things first, and then we'll come back to that one.
So Nexus Mutual is kind of one of the more interesting models around. I mean, especially for your token, right? The token that you have, the NXM token, is not, the price is not determined by the demand. I mean, to some extent, why the demand and supply, but I mean, more concretely via a bonding curve, and there's some complex formula involved. I'm interested to hear, why do you guys choose to use a bonding curve? How do you even come up with that formula? And why not just use a normal demand supply pricing mechanism like all the other tokens?
Yeah, so I think the main point here was when we were, it's all about capital efficiency. The bonding curve is primarily to manage capital efficiency of the mutual. That's its main goal. So it's to make sure that the mutual has enough capital to be confident in paying claims, but not too much capital that it's not being actively used or efficiently used. That's the entire aim. And so we were struggling with this idea that at the time, where you had like all the ICOs going on, where people would basically do an ICO, here's the token supply, we raise one lot of capital, and then we don't really ever come back for more capital. So that didn't really work from Nexus' point of view, because Nexus needed to kind of get some capital to start so that it can start selling cover, and then it needed to attract capital on an ongoing basis to match supply and demand. And so we needed a continual way of matching that supply and demand. So that's all it's about. So basically, when we write lots of cover, the capital that we need to back it increases. And so what happens then is that puts a dampening effect on the price so that it attracts more capital. And when we've got excess capital, we generate surplus, etc., and that remains in the pool, and that gives us excess capital, then the price is pushed up. And that encourages people to take money out and burn the NXM token in at the same point. So that's the entire mechanic. It's all around the capital efficiency. And I mean, it does, I mean, the curve is there and it's a structure, but it does effectively allow supply demand, because the more people that want to buy it pushes it up, and the less people that want to buy it pushes it down as well. I guess the key difference right now, especially, and perhaps this is might fall to your next question, is we're currently at like the minimum capital, so you can't actually sell on the bonding curve right now, and that's really important. Like insurance entities need permanent capital so that they can be confident that they can write risk that occurs over a longer term period, and they need to make sure that the capital is actually there to pay potential claims.
So this is where the wrap NXM token come about. I mean, I guess the community kind of launched WNXM token, because I mean, to get NXM token, you can only get it from the bonding curve, and you need to KYC with this mutual, which is a UK entity, and so on. And then MCR percentage at one point was really high, 200+%, sometime during DeFi summer, but it's gone down to like, I think, to the minimum, which is 100%, 99, 900%. And there's a gap between the WNXM price and the NXM price right now. It's been like this for the past few months, I think since the start of the year, I think since late last year or so, right? So I'm curious to hear, right? I mean, this gap hasn't been closed for some time. Do you see this gap ever closing? What do you think it would take for the MCR percentage to go above 100% again?
Yeah, I mean, it's kind of market and sentiment driven a lot, so it's hard to know exactly when it will close. But however, what does happen, I'll kind of describe the mechanics. Like anytime the mutual generates surplus or investment earnings, and surplus is basically cover costs or premiums less claims. So anytime it kind of gets writes good business, that extra surplus remains in the capital pool. And the same thing with investment earnings. Anytime the capital pool is in, like, starts earning returns, which it currently is, then that remains in the capital pool. And what happens then is that just pushes the MCR up. And so it pushes it over 100. And then what happens is someone burns NXM and to extract the excess capital over 100%. And then, because essentially they can buy wrapped NXM at a lower price and then burn NXM at a higher price and get a bit of a like 20 to 30% arb essentially. And so that will keep going. So if the market doesn't push the wrapped NXM price up, then that burn just keeps on going and NXM supply keeps going down. So in my mind, if we have adoption, we write good business and there's solid investment earnings, eventually there'll just be enough buy-side pressure from the burning that the arb will close.
You raised an interesting point about investment earnings from the mutual, right? The capital that you guys hold, that the community holds, I suppose. So I believe that the ETH that you guys hold that is held these days is invested in Lido's ST ETH and earning some, I don't know, 8% return or so per annum. When do you guys started doing this, and is that the only investment that is done right now, or is there plans to add more investments?
Yeah, so this is a really critical part of any kind of insurance business. Insurance businesses basically have two revenue streams. One is the kind of underwriting profit, premiums less claims, and the second side is the investment side of the balance sheet or the float. Nexus hadn't really enabled the investment earning side, and that's only kind of started about 6 weeks, something like that ago, maybe 2 months. And we've allocated about 10% of the capital pool into staked ETH, into Lido staked ETH. So we've just kind of started. That's our first investment, I guess, as a DAO. And there are plans to kind of add more and more over time. The key thing is that we need to make sure that we have the capital to pay claims. So we're not going to be aping into really aggressive, risky stuff. It's more, we want the comparable government bond or highly secure corporate bond world, version in the crypto world, which is a lot of that is the staking derivatives and those types of things. Makes a lot of sense. So we're looking to expand that slowly over time, and that will benefit all the members because it'll just grow the capital pool that we've already got.
So, I mean, when you start investing into other DeFi protocols, right, I mean, that obviously incurs risk, right? I mean, just because, I mean, you guys invested in, I mean, Lido's STETH, but if you guys made the wrong decision to invest in Stakehound's STETH, that would have been disastrous, right? Because they custody their ETH with Fireblocks and they lost the keys. So now those STETH would essentially be worth nothing now. So as an insurance product, it's just obviously a big risk that is being taken on. How do you balance between the risk and risk that is incurred by investing in one of the other DeFi protocols that is supposed to be insured by Nexus Mutual as well? Yeah.
Yeah. So there's a couple of things there. Firstly, we have to make sure that we don't overexpose the mutual to any one particular risk, whether that's on the claims side or on the investment side of the balance sheet. Because if we put all of our money in Lido as an example, and Lido went down, then we've got a really big problem. But if similarly, if we put all our money in Compound and Compound went down, we've got a really big problem. So the point here is we don't want to allocate too much of the investment pool into something. So we're basically just trying to manage. If anything fully went down, then we'd still be okay and be comfortable paying claims, which is one of the reasons we've only put in 10% of the pool into Lido right now. Mm-hmm. Some people suggested, we should be putting 70 or 80, and I'm like, well,
it's dangerous.
So that can put the whole mutual at risk if something was to happen. The probability of something happening might be very low, but that's not what we want to be at all. So that's a really key point from a risk management point of view, that the community and we've now got an investment committee run by the community, and so they're kind of making some recommendations to the broader community about which assets we should invest in.
You guys are the first DeFi insurance play in the space, and ever since you guys launched, you guys, I mean, had runaway success, I suppose. Your TVL, your fully diluted valuation, market cap has all been pretty high, and when that becomes high, obviously it attracts competition. We start seeing a bunch of other insurance providers come up in the past 1 year. What do you think you guys need to do to maintain your leading position? Do you see any threats, and how do you guys plan to counter those threats?
I think from my point of view, we're just playing our own game here. Insurance is, in my mind, like order of magnitude harder than some of the other financial protocols. And also it's quite trust based in a weird way, right? We're trying to minimize trust, but you kind of have to kind of trust the protocols to actually pay the claims in times of need, right? And so that trust can only effectively be gained over time, and actual, genuine. We've paid claims before. This is how it actually works, and so we're a long way ahead on that side of things. But I think I kind of, experience from the insurance world and understanding about how the structures work, I think that puts us that's a key advantage for us. I haven't seen anything other platform out there that I really like from an economic point of view. I kind of see some fundamental flaws in most of the other stuff I've looked at. Obviously, it doesn't mean things can't change and they can improve and all the rest of it, but maybe that's just version 1. But that's kind of where we're at right now. But like, our goal is to just increase demand and focus on increasing demand. And if we do that, we'll do well for our members.
Let's talk about decentralization, right? I mean, I know you guys have been on a path towards decentralizing your governance. Walk us through some of and you guys have a community fund recently as well, I believe. So maybe walk us through some of the initiatives that you guys have taken from the kind of the start of the journey, and how you guys are decentralizing progressively over time, and kind of what's the plan to decentralize further in the coming months.
Yeah, so this is a continual effort, and I think we've been making some really good strides recently. From a technical point of view, we've moved some key elements fully on chain. We've kind of got one big one extra to go, which is moving the pricing on chain. We're working on that right now. And then I guess one of the other key elements is like the legal wrapper, actually, our community are really pushing forward on that one and have started getting legal advice about potentially dissolving the legal wrapper. And so like the discussion started and the things are progressing there. And that one's really interesting because we haven't really initiated that. Like, that's all being community driven. And so there are kind of a lot of elements there. I guess the kind of bigger outstanding, we've got a community fund, which is kind of starting to employ people and stuff. So it's not just the core team doing development and other work. In terms of like bigger long-term, I think the biggest kind of long-term steps are probably going to be potentially removing the legal wrapper if that goes ahead. And secondly, I think we actually have an advisory board, which is basically our multi-sig. Legally, they are the directors of Nexus Mutual Limited, so the legal wrapper. And they have some extra powers in the system. And I think we're also working on mechanics to basically pass that to a subgroup of the membership base, because I think that's an important step that will probably happen. We need to do a bit more work and thinking there on the exact mechanics, because there's risk involved, but that's one thing we're working towards as well.
I find Nexus Mutual quite interesting in the sense that you guys have a legal wrapper, whereas the other, and to use Nexus Mutual, you kind of have to KYC. I mean, until like Rep NXM and Armor came about, I mean, the only way to use that, I mean, a couple of years ago was kind of the KYC version. Whereas if you look at the rest of DeFi, it was kind of no KYC needed for every other thing to use the rest of DeFi. And then, I mean, if you look at some of the regulatory discussions that's been going around, like some of the talks have been, I guess, how do you think regulators will look into DeFi? Do you think we will kind of reach a stage where everyone's got to be KYC'd and to use DeFi, or just like how NXM was in its early days, or will it kind of be like the rest of DeFi where there's no KYC needed and kind of free for all?
I don't know, basically. But I think I would like a bit where I'd like to see it go, because I fundamentally think that the regulators aren't going to be happy without some form of KYC AML in there somewhere. But what I would like to see is the DeFi protocols themselves essentially be permissionless software that is non-custodial in its entirety, and therefore it's like a neutral base layer. And then if people want to regulate something, they regulate the on-ramps on and off, the access points. And that makes it free for anyone to participate if they want to on their own terms, but it also gives the regulators the ability to control major retail flows and I guess other stuff if they want to. So I don't know. That's the way I hope it goes. I'm not quite sure if that's the way it will go, but yeah, I guess we have to wait and see. I mean, fundamentally, from a regulatory point of view, I think one of the things I'd really like the regulators to grasp is the fact that fundamentally this technology can provide a better solution than the existing financial infrastructure. In particular, like the non-custodial nature of it means you don't have to trust people. If we get it right and we do it right, and there are no admin keys, and the code's been battle tested really hard, then the trust that you need to you're not handing over trust to anyone, and that's a fundamentally better financial infrastructure to build on than the current financial world, which is basically trusting a whole bunch of people and then regulating around it to make sure that they look after the money properly. I'm hopeful that the regulators view it that way rather than try and protect their existing interests and try and shut things down.
Mm-hmm. Yeah, I think you said it quite well. Let's see. I mean, it's kind of a wait and see game, and hopefully things pan out good for DeFi in the long term. I think we're coming up towards the end of our podcast, but I would like to bring up something that happened last year, I suppose. There was an unfortunate incident that took place in December, where you lost 370,000 NXM token, or roughly $30 million in today's price. From what I read, it seems to be like a targeted MetaMask exploit on you personally. Just curious to hear, has there been any update on the incident since then, and any advice on things for us so that we can kind of also improve our security practices here?
Yeah, exactly. Yeah, no, basically, very short answer is no, no update. We're just treating the money as gone. Hackers took it. So just, I guess very quickly, the way it kind of worked was I use a hardware wallet through MetaMask. MetaMask, my entire computer was compromised. And it turns out that it was more than likely from a Word document, so a docx file that was sent from my CTO to me, but it was a spoofed email, and the wording, so the title of the document was something that we were discussing over the past day. So the point being that the hackers were obviously in the Discord channels, in the Telegram channels, monitoring the chatter, and then targeted the attack to give the most likelihood that I would open the file. So I opened the file, and then I guess from that point on, my computer was compromised. It probably took about a month or two for the hackers to kind of line up the attack, as it were. And essentially what they've done from there is have a compromised MetaMask. And when I went to claim some yield farming rewards, the transaction appeared in MetaMask and it was fine. Everything looked okay. And then so hit confirm, and then it goes to the hardware wallet. And because you can't read the exact details of what the transaction is on the hardware wallet, it just gives you hexadecimal stuff, and unless you really know what you're doing, you don't know what you're approving. I just click through and hit approve. So my private keys weren't compromised, but they tricked me into sending them a whole lot of NXM. So I approved a transaction when I shouldn't have approved. So it is on me from a security point of view, but it's essentially a spoofed transaction. And basically, we know it was crafted for me because I'm basically the only one that could ever send that amount of NXM. So it was specifically targeted. And so I think from the learnings point of view, I think that's most important for everyone in the community. One is never click on links and stuff. Secondly, always use a hardware wallet. Also, I would, if you have any material amount of money, I would make sure that you have a different computer to sign transactions on that basically doesn't do anything apart from go to a few websites to do the transactions, and doesn't have email or any other social or anything else on it. And that way, you're, I guess, a bit more secure. I personally also make sure that I double check the to address on the hardware wallet and the exact details before approving it now, which is an absolute pain from a UX perspective. But I've got into that new habit now, which is fine.
I mean, the scary part about this hack was, I mean, you actually use a hardware wallet and you still got compromised. So that is it's absolutely hard to kind of be more secure than that. Like, so basically your computer's compromised. So the hacker kind of took over, uninstalled the real MetaMask and kind of put in place a fake MetaMask. And then when you kind of want to make a transaction, so it spoof the to contract address to a wrong one.
Yeah, that's right. So it basically, the private keys are fine because they're still in the hardware wallet. That hasn't been breached, but they've tricked me into approving something, thinking I was approving something else. So it's like they got access to your bank account or something, and you've basically got I'll add a payee, and you've clicked yes, I'll add that payee, and instead you've sent someone a whole lot of money. So that's kind of what's happened.
So basically the TRDR is use a hardware wallet and then check the to address as well when you want to interact with any smart contract, youth farming or anything. Yeah, which
I understand is pretty rough, because I've just been doing it every day now. But I guess there are other solutions out there as well, like the Lattice. I mean, I haven't got one, but the Lattice from Grid Plus
gives Grid Plus.
It gives you a full screen, which shows you the full details of the transaction, which is a lot easier to read and understand what you're doing than a Ledger or a Trezor, which basically has to provide small screen, hard to see exactly what you're approving.
Yeah, I mean, it's quite scary that you go spoof on a DOC, a Microsoft Word document, which was, I mean, it's kind of a very typical file to open. And were you using a Trezor ledger or a Windows laptop back then?
Yeah, so the key thing is it was a Windows exploit via the docx file. So I guess you're safer if you use Mac or Linux, but still,
I mean, if it's targeted, like, I mean, the hacker could do anything. And it was a Ledger or Trezor?
Ledger. Yeah, it was a Ledger, but that's kind of really, that doesn't matter so much, really.
It was kind of scary, like all these things. But I mean, really appreciate you sharing some sharings on how we all can improve our security practices. I mean, I wrote a thread on Twitter recently on some of the things that you could do. There was like 15 tips or so there, but I mean, this is like next level stuff. It's just a lot more harder.
I think exactly. I think this one was pretty scary because I think in general, like, I obviously made the mistake. I approved the transaction. I shouldn't, but I think there are so many like DeFi power users and people that have been in the space a while that would have probably also been impacted if they were in a similar situation. Like they would have been tricked as well. So yeah, I mean, I think I love self-custody and everything, but we do have some challenges to address if we're going to be able to get this to retail people.
All right, one final question before we end this podcast. What's kind of the exciting upcoming plans for Nexus Mutual this year or next year, I suppose?
Yeah, we've got a lot coming up. I mean, a lot on the kind of distribution side and getting cover and demand out there. Also, increasing investment earnings, that's big as well. But I guess on a more technical level, we're looking to redo some of the core mechanics, just really make them DeFi native, enhance the staking mechanics. Delegated staking is probably going to be a really big one.
Interesting.
At the core level. And so that can be, I think that can open up a lot of different opportunities and stuff like that. So there's a lot of stuff happening, and we've got some good releases coming out.
Thank you very much for sharing these updates, and really appreciate you taking the time to come on the CoinGecko podcast, Hugh.
Cool. Yeah. No. Thanks for being here, and thanks for it's been great. Good chat.
This podcast is provided as part of the overall information on cryptocurrency contained on our website, is for your general information only, and does not howsoever constitute any endorsement, financial or investment advice, nor any solicitation or offer of securities or other financial instruments. CoinGecko and the podcast presenter makes no warranties, implied or express, of any kind in relation to this podcast, including, without limitation, the accuracy and updatedness of its content. All opinions and recommendations there in the podcast are based on the personal opinion of the presenter. Please conduct your own research and procure professional advice should you, at your own risk, decide to howsoever invest or trade in relation to the content contained in the podcast.
For the latest crypto prices, visit our website. If you haven't already, make sure to subscribe to our YouTube channel to keep up to date on the latest crypto trends.